Hi, good afternoon, everyone, and Happy New Year. Thanks for taking your lunch time to join our webinar today. So today's the webinar will be titled Bond Yield During Rate Reversal. And today we have with us our Phillip's Fixed Income Desk, as well as myself, who will be conducting this webinar. Yep. So as always, uh, this is just a disclaimer that this sharing session would just be for educational purposes and not to be treated as financial advice. So all investors and advisors are still supposed to do their own due diligence before making any investment decisions. So let me quickly run through briefly on what we'll be covering for today. First, we'll be starting off with a quick recap of last year's fixed income market in Singapore, followed by the current bond yield environment and how it is likely to trend moving forward. Will it trend even higher or will it trend lower? Then afterwards, we'll be sharing a little on how will the movement on interest rate impact our government securities. Is it still wise to park your fund into Singapore treasuries or even fixed deposits? And lastly, we'll throw in a few bond ideas and to perhaps spur some interest before concluding the session with some Q&As. So yeah, without further ado, let's take a look at the bonds volume in Singapore for the year 2023. So as we all know, the year 2023 hasn't really been a rosy one for fixed income investors because due to the sky high interest rate, it has not only caused bond price volatility, but also placed pressures on corporates' credit health due to higher borrowing costs. So in 2023, there were 48 bonds, there were 48 bonds with size greater than 100 million that were being issued in our local denominated currency. Of the 48 bonds that were being issued, the sector that has contributed the most of the bonds issuance is mainly made up by the banks. So why is this the case? Because as I mentioned earlier, due to the uncertainty rate increases environment, this has posed a challenge for both the corporate firms to issue new bonds. Whereas for banks, on the other hand, most of them were showing stellar results with record net interest income as they benefited from the higher interest rates. So this is because when interest rates are high, bank makes more money by taking advantages of the greater spreads between the interest that they pay to their clients and the profits they earn by investing by investing. So therefore banks were confident in their earnings which enables them to continue with the newer bond issuance last year. So in this graph, it is just a rough illustrations on the bond issuance that I've mentioned briefly previously for the year 2021, 2022, and 2023. So as you can see, right, for the year 2022 and 2023, bonds issuances have not really been the greatest when interest rates started to climb back in March 2022, when the Fed has started to raise interest rates. So yeah. So the question is, would that be the case for this year as well? Will rate continues to pull even higher in 2024? Well, first, I mean, we have to look at the summary of economics projection, or SEP in short, which was released by the US Federal Reserve back in December last year. So for investors who are unsure of this graph, on the left, it's a dot plot graph, which was provided in the last meeting. So in this graph, the committee members hand down their individual rate expectations for the current and the years to come. And this graph, it's only released every quarterly of the year. So, I mean, as depicted in this graph, for the year 2023, all of the members have expressed that the central bank policy rate is at its peak. But if we look at the projections for the year of 2024, the mean projection is at 4.6%. And as of current, the federal fund rate stands at 5.25 to 5.5%. And with a projections of 4.6% for this year, it gives us an indication that there could be potentially three more probable 0.25 or quarter point percentage rate cuts happening this year. And I mean, subsequently, rates will falter further towards their targeted range of 2% in years to come. So secondly, in the latest data release, inflationary indicators such as the Consumer Price Index, which is the CPI, and the Personal Consumption Expenditure, which is the PCE, are consistently indicating progress of inflation easing off. So I mean, most of the recent figures, the most recent figures for November shows that headline CPI and core CPI is at 3.1% year-on-year and 4% year-on-year respectively. So I mean, this is slightly lower than October's reading of 3.2% and 4.1%, primarily due to a decline in energy prices. Furthermore, in November, the total PCE and core PCE also pointed to lower numbers at 2.6% year-on-year and 3.2% year-on-year, respectively, compared with their October figures of 2.9% and 3.4%. So, I mean, these positive data sets portrays that the economy is indeed slowing down, and it is slowly but surely moving in the right direction. But I mean, despite all these encouraging results, the committee members have always noted that they still require some time before it reaches their targeted range of 2%, and a further rebalancing of their labor market would definitely help to ease the upward inflationary pressure. So yeah, moving on. This is the Fed funds future curve, which indicates what the market is expecting interest rates to trend for this year. And although, I mean, the market is in line with the committee's direction of rate cuts happening this year, the market is pricing in for rates to fall to a range of 3.958%, which translates to an approximate of 150 basis point cut for this year, with rate cuts coming in as early as March this year. So, I mean, I believe that a 150 basis point cut to happen this year will be unlikely because first, in the SEP, the Federal Reserve has indicated that they're expecting their rates to fall to a range of 4.6% for 2024. And also, in the latest December US non-farm payroll data release, it has also shown that the US economy still remains resilient despite the high interest rate environment, with unemployment rates coming in at 3.7%, slightly lower than the expectation of 3.8%. Thus, I mean, these data pointers would definitely play a major role in the decision-making process, while also dampening the optimism for any early interest rates cut. So, I mean, all in all, will rates continue to pull higher this year? I believe that it is highly unlikely, with most of the indicators pointing towards a similar direction. But with that said, the possibilities of interest rate trending even higher is still plausible if a black swan event such as a geopolitical tension were to happen. So with that being said, if rates are expected to come down this year, what will be the impact for our local government securities such as our SGS or treasury bills? So I mean, as we all know, bond yields move in tandem with interest rates. So when interest rate goes up, bond yield goes up. When it goes down, then vice versa. So if interest rates are projected to taper down this year, similarly, we should experience a slight decline in our Singapore government securities yields as well. But however, I mean, the yields for our treasury bills should likely be range-bound during the first quarter of this year, given that the rates are guided to be higher for longer. And only after consecutive disinflationary data pointers release, only then will the tapering be would probably happen when the Fed signals for a rate cut, which I believe it will likely happen in the second half of this year, but not the first half. So if you were to look at this chart, right, which is the yield curve for our 6 months treasury bills, you can see that the yields has been consistently been between the range of 3.6% to 3.9%. So I mean, the next 6 months T-bills window will be available for subscription tomorrow, and with that, the cutoff yield should likely fall within the range, a similar range of 3.6 to 3.9% as well. So the latest 6 months T-bill cutoff yield was at 3.74%, as shown in this slide down here. So next up, if you were to look at this chart, which is a comparison between the Fed fund rate and a few of our Singapore government securities, it can be seen that our government securities are hovering within their range, except the 10 years SGS bond showing a slightly more profound decline due to their higher sensitivity nature. Also, I mean, with the yield curve being inverted still, between the shorter tenor treasury bills of 6 months to a year versus SGS bonds with of different tenors, I mean, the short duration bill still remains fairly attractive as compared to the SGS bonds, because as the yield for longer duration for the longer duration bonds such as the SGS bonds are not sufficient to compensate the investors for the duration risk that they are taking. So additionally, for investors who are in a dilemma to choose between T-bills or fixed deposits account, our local, this is just a small table that they have drafted out, because our local banks such as DBS, OCBC, as well as UOB, their fixed deposits are currently offering at a lower rate as compared to what our government treasury bills can generate for similar durations. So as you can see, like I've mentioned just now, our 6 months T-bill range is around 3.7 range, whereas for our 1 year as of current, it's also around 3.7 range. Whereas for DBS and UOB, they are hovering around 3.2 for a year's duration. Whereas for OCBC, it's around 2.7 if you register in the branch, or 3.1 if you register online for half a year. Yep. So, I mean, it would be a better investment decision for investors to park their funds into our government treasury bills instead of the fixed deposits. Okay, so moving on, now I'll be sharing on some of the bond ideas for this seminar. And the first bond that we will be sharing would be Capital Land Escort 3.88 perpetual. So, I mean, for this bond, it is announced back in 26 August 2029, and it has a coupon rate of 3.88. So it has approximately 8 months left till the next refix, and the reset date for this perpetual will be on the 4th of September this year, and every 5 years thereafter. So during the reset, right, it will be reset. The bond will be resetted at a 5-year SOR plus an initial spread of 2.352%. So currently, for this perpetual, the indicative price is at 98.755, which translates to a yield to call of 5.968%. And as of current, today, our 5-year SOR is at 2.73%. So why did we pick Capital Land Escort? So first of all, it's because of its healthy and attractive properties. So in their latest third quarter results, the Capital Land Escort portfolio revenue RevPAR increased by 17% year on year, which is at $154, which has already exceeded their pre-COVID pro forma levels by 102%. So secondly, for Capital Land Escort, right, they have two types of revenue stream. One is their variable stream, as well as the other one is their fixed revenue stream, which is more towards their longer stay properties. So for their longer stay properties, it has remained resilient, with 95% occupancy for its rental housing properties. And one main contributor in this segment would be their standards at Columbia, which is a student accommodation. And it has more than 90% student occupancy upon opening, which is back in, if not mistaken, last year, August. So zooming into their credit health, for CapitaLand Escort, they have a very conservative approach for their capital management. So for CapitaLand, they Escort, they have a gearing but of 35.2, which has came down from 38.6 percent from the second quarter of this for the second quarter of 2023. And for Escort, they also have a very high liquidity buffer of approximately 1.3 billion, which is made up of 500 million cash, as well as 790 credit facilities. So this is more than adequate to pay off most of their near-term debt obligations. And also, CapitaLand Escort is also rated BBB from Fitch itself. So CapitaLand has increase in rating from Fitch from BBB minus to BBB back in May last year. Yep. So okay, now I'll like to roughly talk about why did we think about CapitaLand Escort 3.88% just this perpetual. So for this perpetual, right, the size of the issuance is at 150 million. And if you were to utilize the current 5 years SAW as a benchmark during the reset, because it's resetting in 8 months' time. So if these bonds are not being called on the 4th of September this year, the coupon will then be reset to a rate of approximately 5.08%. So you get like 2.3%, 2.73% plus 2.352%. And this coupon rate, it's higher than the current coupon rate that they are offering right now. So, I mean, with a higher coupon rate, this will translate to a higher borrowing cost for the REIT itself. Therefore, I mean, after the reset, for higher borrowing costs, this will definitely be weighing more on the REIT itself. And this might entice them to do a redemption on the 4th of September 2024. And yeah, so this is why we mentioned about this 3.88% perpetual. So talking about CapitaLand Escort perpetual, I believe some investors might be holding onto their 3.07 perpetual as well, and they might like to inquire about it as well. So, I mean, because this perpetual has not been called for quite a while now, so maybe let me share why this perpetual might not, they might not have called this perpetual for quite some time. So for the Escort 3.07 perpetual, this issuance, for this issuance, right, the next call date for this perpetual will be on the 30th of June this year. And the size of this issuance is 250 million. And if we to utilize the current 5-year SAW, 5-year SAW rate as a benchmark again, during the reset on the 30th of June 2025 next year, the coupon rate will then be reset to a rate of approximately 5.23%, which is 2.73% plus 2.5, which is higher than the 3.07%. Yeah. However, rate expectation are pointing towards a lower rate outlook in 2025. Therefore, I mean, when it comes to the reset in 2025, this 5-year SAW this 5-year SAW might come down eventually. Therefore, I mean, the coupon may then be resetted to either a similar coupon range or even lower, whichever, you know, it might be lah. And this might deteriorate the possibility of a call action being made, as the lowering borrowing costs will be more favorable for the REIT itself. Therefore, between the 3.88 perpetual versus the 3.07 perpetual, the likelihood of the 3.88 perpetual the likelihood of being called for the 3.88 perpetual is higher than the 3.07. Yeah. So all in all, as mentioned above, I believe that CapitaLand Escort should not face any difficulty in the repayments of its debt obligation, given its prudent capital management as well as their high liquidity buffer. Yep. So moving on to our second bond, this bond would be Fraser's Property, 4.15%. This is a senior bond that has a maturity date of 23rd Feb 2027. So this bond's coupon rate is at 4.15%, and it has approximately 3.1 years more till maturity. And the indicative pricing for this bond currently is at 100.1, which gives us a yield of 4.112%. So I mean, this price, it's fluctuating. So perhaps even this week you might have a chance to grab it at par value at 100, and you might gain a yield towards of 4.15%. So why did we choose Fraser's Property? So first of all would be their sustainable earning growth. So in their FY 2023, their revenue has increased by 1.8% year on year from 3.87 billion to 3.94 billion. And secondly, their pre-sold revenue for their FY 2023 amounted to 2.6 billion, which is similar to their last year's pre-sold revenue as well. So this provides their fixed income investors with an earning visibility from their residential development pipelines. And this will give the investors a rough sense of confidence when they hold the bonds of Fraser's Property. So for Fraser's, their profit before interest and tax has also improved by 5.1% year on year, mainly due to the higher contribution from their residential businesses, as well as their maiden contribution from the acquisition of the stake in Next, as well as improved results from their hospitality operations. So yeah, so this the third bond that we'll be sharing would be also be on Fraser's. So for bond idea number 2, right, it's more for investors who like a maturity date and who are less risk adverse, and also would like a shorter duration bond. Yeah, if I may say that. So for bond idea number 3, we are pushing for Fraser's Property 4.38% perpetual. So this bond was announced back in 8th of January 2018, and the coupon rate for this is 4.38%, and it has approximately 4.7 years to the next refix. And the reset date for this bond is on the 17th of January 2028, and every 10 years thereafter. But do note that this is a perpetual, so redemption is not guaranteed. So the reset rate for this bond itself is at 10 years SOR plus an initial spread of 2.18% plus a step-up rate of 1%. Yeah, so the indicative pricing for this bond currently is at 95.694%. 95.694, which translates to a 5.593% range. So secondly, why do we choose Fraser's Property? Although I mean Fraser's Property have most of their fixed debt have most of their debt being hedged and fixed at 72.4%, which an average cost of debt of 3.5%. This is slightly raised higher due to the higher interest rate environment. If I'm not mistaken, I think previously their cost of debt is roughly around the range of 2.7-ish. Yeah. And also for Fraser's, the average weighted debt maturity is at 2.6 years with an interest coverage of 3 times. So for Fraser's Property, their cash and bank deposits is currently standing at 2.65 billion. And however, it was at 3.3 billion previously back in 2022. And this reduction was mainly due to the redemption of their perpetual securities back in October 5th, 2022, and also due to the acquisition stake in Next, which they utilize the cash and bank deposit to pay. of a portion of this next acquisition. Yep. Okay. So yeah. So finally, we have so to conclude, right? For interest rate, we are expecting it to hover a little longer until the Fed starts to see more meaningful data pointers, which should then provide them with the confidence to start the tapering off process. And this view is also further supported by the Fed's minute as well, that was released just last week, which they have also suggested that rates have probably peaked, but rates will have to stay a little longer to combat the stubborn inflation that we are currently facing. So secondly, although yields have come down slightly by approximately around, I think, 50 basis points across all fixed income since last year, the yield curve, like I mentioned earlier, is currently still inverted. So for investors with a shorter time horizon, a short-term play would be to look into short duration treasury notes, as they are currently still giving off a decent yield while providing investors with a shorter duration risk. Though, I mean, investors might face a reinvestment risk once the treasury notes have matured in 6 months to 1 year time frame. Investors could then look into using that capital to reinvest into other shorter term duration bonds. However, I mean, if investors could look into having a mixture of short-term as well as long-term bonds, then that would be the best, because within their portfolio, right, they are able to take advantage of the inverted yield curve for shorter duration bonds. While for the longer term play, it would be great to look at investment grade bonds with durations of around 3 to 5 years time, to lock in the rates that they are comfortable with before yield starts to come down in the following years. So right now, when we are still in a rather high interest rate environment, bonds are being issued at a steeper level, I would say, at a higher coupon rate. So once, let's say, you have attain a bond that gives off a relatively attractive coupon rate, and once interest rate starts to taper down, yields will tend to follow suit as well. And then your bond prices that you have locked in right now as of current would then increase as well. Yeah. I hope that makes sense, lah. So yeah, I believe that's all I have for today. Perhaps if you guys have any more questions, right? Perhaps you guys can head down to our Poems Mobile Tree app, and we have a community group, Phillip Bonds group. You can put down your questions there, and I'll try to answer it. Yeah. Or perhaps you can email in to us, and we'll clarify your queries. Okay. Thanks. Thank you all for taking your time today to listen to our quarterly webinar. The next one will be in April. Yep. Thank you all. Bye-bye.